guys, Brian Stevens with the National Real Estate Post from the CFPB. Because non-banks, that would be your brokers and independent mortgage bankers, are not held to the same scrutiny, it's been deemed that a friendlier regulatory climate than what depository bank lenders work in, non-banks,
Clearly that's me.
have become the dominant force in mortgage lending. About 70% of first lien originations made in 2021, 70% came from non-bank originators. Now, never mind the independent spirit of the independent mortgage loan officer and the broker, you know, the hustle, the self-reliance, and the self-determination versus what? A slug sitting behind a desk at Wells waiting for someone who's been titillated by a Western-themed commercial to waltz through the front door and say the image of the stagecoach was a difference maker and let's do this refinance right now? Survey says, apparently not. Big banks, big pockets, big logos, big commercials is evidently only good for about 30% of the mortgage market. For the CFPB to say non-bank mortgage companies rule the market because of a lack of regulation is absolute utter absurdity. Because remember, just a few short weeks ago, I told you that when it came to depositories that are heavily regulated under the Community Reinvestment Act, they had Community Reinvestment Act results that were actually worse than non-bank loan officers who have no such supervision, regulation, or oversight. It's kind of like it's better when the government doesn't get involved. The CFPB doesn't understand why non-bank loan officers do better because it's all about hustle and hard work. By and large, depository loan officers are simply loan officers that couldn't hack it in the open market, so they moved to more bureaucratic positions with the big banks. Nothing wrong with that, it just happens to be the truth. The CFPB is a giant bureaucracy and they understand bureaucracy, not necessarily the hustle required with an open market loan officer. So it must seem to be regulation to the CFPB, right? The CFPB asking why banks are losing the mortgage market game is like asking why the Washington Generals can't beat the Harlem Globetrotters. But enough of that for now. What does this mean to you? Well, in his testimony this last Monday, CFPB Director Chopra said, given the rapid growth of consumer offerings by non-banks, the CFPB is now utilizing a dormant authority, that's right, a dormant authority to hold non-banks to the same standard that banks are held to. This authority gives us, the CFPB, critical agility to move as quickly as the market, allowing us to conduct examinations of financial companies posing risk to consumers and stop harm before it spreads. Wow. So what does that entail? Bear with me on this for a couple of seconds, guys, but it's a whole bunch of stuff. Number one, they're going to collect data on your company from both inside and outside of the Bureau to see who's talking crap about you and your company. Number two, then they're going to request and review supplementary documentation on said complaints about you again and again and again, so you better have your books in order. Three, they're going to develop and obtain internal approval for the onset portion of their examination of your company. That means the CFPB is going to show up to your office, so make sure that your files and computers are locked down when you get up from your cubicle. And number four, it's field trip time. That's right, they're going to come to you, conduct interviews and review additional documentation and information. Just think, the CFPB at your office, asking your admin and setup if you ever leave files out or whatever else they want to spill on your guys. I sure hope, by the way, on a side note here, that your Christmas bonus on your record production last year was in step with expectations of that setup person, or else it might be a long examination. Number five, go internal and talk to their own CFPB legal to see if the examination indicates potential unfair, deceptive, or abusive acts and practices, discrimination, or other violations of the law. And oh boy, are they looking for this one right now. This specific point is the Bureau's main focus, and I tell you, they're looking for blood and they're going to find it with some of you. Number six, draw preliminary conclusions about the regulated entity's compliance management and its statutory and regulatory compliance, or to put it another way, they're going to sharpen their axe. Then they're going to draft a report, then internal reviews and approval for the final report, then share the report with regulators to see where you screwed the pooch and what, if anything, that you're going to have to pay. That's what they're going to do. Now, the CFPB, for some inexplicable reason, is looking at language in Dodd-Frank that allows them this directive. And why are they doing it now? It seems to me the midterm elections are right around the corner, and trolling for headlines before the election seems to be a pretty expedient place to be. It's sad, but it might just be true. But the rule does give the CFPB supervision over non-banks. Sad, but true. You see, the rule gives the CFPB supervision over non-banks whose activities the CFPB has reasonable cause to determine pose a risk to consumers. This authority is not specific to any particular consumer financial product or service. While the CFPB did implement the provision through a procedural rule in 2013, the agency has now begun to invoke its authority. Again, why now? Elections. This rule that they're dusting off is going to allow the CFPB to be agile and supervise entities that may be fast growing or are in markets outside existing non-bank supervision programs. Now, banks, depositories, this is their world. It's always been their world. If non-banks, especially the recently minted IPOs, are held to the same standards on these examinations as our well-known institutionalized depositories, it might be a long second half of the year for them. And for many of you, it's going to be hard to get past the first point, which is see what the word on the street is about your company. Again, might be something of a rough start. I say this because, and this is truly sad, but the Bureau is in it to make headlines. And there are no headlines in finding a way to bust Bob's Mortgage Shop and Shaved Ice Cream in central Topeka, Kansas. No, they want the IPOs or the companies with deep pockets because that makes a splash and that makes for headlines. Of course, regulation, examinations, and penalties, they all cost money and they all take time and they will all undoubtedly lead to even more lenders leaving the market, which will put even more upward pressure on mortgage interest rates because this all will cost lenders more than what they're making today, which is record low profit margins, thus ultimately making loans for consumers even more expensive, all in the name of consumer protection. The irony is thick here, isn't it, people? Now, when you think of it, higher rates in the name of consumer protection, ain't that just so government of them? But this is the world we live in. Make it a great day.